Yeah, inventory turnover ratio, I'll explain again. Thank you. In the meanwhile, let me just share a link where you can give your feedback about this session. So I've shared the link, just click on that, and please I request all of you to give your inputs on this so that we can plan how we can improve, how we can schedule this course, okay, or how we can schedule the session even in a better way. So I request all of you to contribute. Now coming back to Chinmay Kohat, sir, inventory turnover holding ratio. Okay, so you want to know the inventory turnover and holding ratio, right? Any other questions? Please explain negative net working capital in the concept of basic accounting equation. Asset is equal to liabilities. Yeah, I'll come back to that. Then there is a query from Shankar Narayan. Sir, please explain debt coverage ratio. Do you mean debt service coverage ratio? Yeah. So coming back to questions one after the other. Debt service coverage ratio. We'll start with debt service coverage ratio. So debt service coverage ratio is basically the ratio that are used by bankers to understand whether you have capacity to pay the loan or not. I'm just repeating. Let's say you are going to take up a project. The cost of the project is 150 million. You have to spend on plant and machinery, land and building, furniture, fixture. And you're going to fund 25% of the project, 37.5. It means the remaining 75% is coming from bank loan. If the bank wants to give this loan, they should be convinced about two aspects. That is, you have technical viability and commercial and economic viability. Technical viability is something which they do it by engaging a technical consultant. Commercial and economic viability they will understand by looking mainly at your debt service coverage ratio. It means they will see what is that you have to repay if you take this loan. If you take this loan, let's say you have to repay in equal installment over a period of 5 years. So this is 112.5. Then you have to pay interest. Now interest I have calculated based on average balance. That is simple arithmetic. How to calculate the average balance? Opening balance minus repayment closing balance. So opening plus closing by 2 give you average balance. On that I have applied 10%. So in that way I have calculated interest. It means you have to pay this loan repayment. You should also pay this interest. Both put together is going to be your total obligation. So bankers would be happy if you have profit to pay this. So they are not going to look at your cash profit. They are not going to look at your profit before tax or after tax or retained profit. They are going to look at what is known as cash accrual. And they would expect that your cash accrual should be at least 1.75 times of your obligation. Here your obligation is 32.63. That multiplied by 1.75, that is your cash profit should be at least 57.09. It can be greater than that, okay, but if it is going to be lesser than that, then bankers will have a kind of reluctance in sanctioning the loan. Similarly, in year 2, if your total repayment is 30.38, they would expect the cash accrual to be at least 53.16. So now the question is how to find out this cash accrual. That's the formula which I gave you. You have to take profit after tax, you have to add depreciation, you have to add interest on long-term loan, and you have to subtract the dividend paid. Now why I'm adding depreciation? Because it is a non-cash item, there is no cash outflow. Why I'm adding interest on long-term loan? Because this profit after tax is derived after subtracting interest. I cannot say that I will pay interest on profit after tax because this itself is after paying interest. So I'm adding back, I'm nullifying the deduction already made. Then I'm going to subtract the dividend that is going to be paid. So this is going to be the cash accrual that is available. So you have to calculate cash accrual for each and every year, and only if it is at least 1.75 times. So shall I make the formula? The formula for debt service coverage ratio, nothing but this is say the cash accruals divided by total repayment obligation. So what is cash accrual? You know, this is the way in which we find the cash accrual. And what is total repayment obligation? We have here total repayment obligation is nothing but principal repayment plus interest. Okay, so that's about answer to JLA. And next one, Chinmay Kohat. Chinmay Kohat wanted me to explain inventory turnover holding ratio. So I think I have those numbers. Let me go back. Okay. Inventory turnover ratio. How we calculate inventory turnover ratio? We will first see what is our annual cost of goods sold. Let's say my annual cost of goods sold is something like 12 lakhs. Let's say my average inventory which I am maintaining is 1 lakh. This is scenario 1. In scenario 2, my cost of goods sold is same 12 lakh, but average inventory which I am maintaining is, let's say, something like 6 lakhs. So now if I create a relationship between these two, that is annual cost of goods sold divided by average inventory, here, let me just change this, 12 lakhs. Yeah. Here I get 12 lakh by 1 lakh, it is 12 times, whereas here I get 2 times. So here your ratio is high and here your ratio is low, and high ratio indicates faster turnover of goods and this indicates slower turnover of goods. When your goods are turned over faster, you are making more sales. It means your profit will be more. Whereas you will make low sales here, okay? Or I mean in comparison with inventory, you are making low sales, okay? So you will have low profit or sometimes even loss. So how we calculate inventory turnover ratio? The formula for inventory turnover ratio is simple. It is annual cost of goods sold divided by average inventory. Okay, this is the formula for inventory turnover ratio. Then what is that inventory holding period? For inventory holding period, what I did, I have found what is the monthly cost of goods sold. That is, this 12 lakh is for 12 months, what is for 1 month? So I have divided by 12, I got 1 month cost of goods sold is 1 lakh, and in the second case also it is 1 lakh. But average inventory, what is the average inventory I am maintaining? Here it is 1 lakh, here it is 6 lakh. So average inventory divided by monthly sales gives me, I am maintaining 1 month inventory, whereas here I am maintaining 6 months inventory. So that is your inventory holding period. So how I have calculated inventory holding period? Let me put it here. Inventory holding period is nothing but, this is the point I have taken. That is, I have taken average inventory, right, and I have divided it by monthly sales, right. So we'll say average inventory divided by sales per, sorry, not sales, cost of goods sold per month or day, so that you can eventually express in days or months. Okay. So that has been done. Then we have Shiv. Please explain negative net working capital in the context of basic accounting. See, in basic accounting, yes, your asset is going to be equal to liability. There is no doubt about that, because if you go by basic equation, your balance sheet, you have to say your assets are equal to capital plus liability. Let's say my capital is 100, okay. My say long-term debt is 100 my short-term debt, basically the current liability, is also 100. So this is a scenario where I have total liabilities of 300 and my total assets, let's say my fixed assets are 250 and my current assets or short-term assets are 50. So what is my total assets? My total assets is also 300. So here if you notice, my current assets are 50, whereas my short-term debts are 100, and if I calculate the net working capital, it is 50 minus 100, 50. So what it communicates is, here you have fixed assets of 250, which is a long-term asset. So this long-term asset should have been funded only by long-term liability. Now capital is a long-term liability. Long-term debt is also a long-term liability. So both your long-term liability is 100 plus 100, 200, whereas you have created fixed assets of 250. From where you got the remaining 50? Obviously, it is from negative net working capital. Negative net working capital. What does that mean? Look, you have borrowed 100 short-term. You have created short-term assets of only 50. It means you had another 50 short-term debt, and that 50 short-term debt was used for creating fixed asset. Now, what is going to be the implication? This is 50 short-term debt which you have used for acquiring fixed asset. Let's assume that fixed asset is a land. Now, whoever have given this 50, let's assume is a bank OD, a dog overdraft. They are coming and asking for repayment of this 50. So what will you tell them? You have to look back at your current asset, but this current asset of 50 is for, let's say, other current liabilities. It means remaining 50. Now let's imagine a scenario that entire short-term debts 100 are asking their repayment. So you can pay 50 from current asset, remaining 50 is sitting in the form of a land, and if you try to sell the land, it will not get sold immediately, because land basically it is a fixed asset. Fixed assets are those assets which are acquired with an intention to use in the business, not with an intention to sell and make it as cash immediately. So it will take more than 1 year for you to get back your money, and it means you are going to be in serious trouble with your banker who had given you that short-term credit of 50. Okay, so negative net working capital clearly indicates diversion of short-term funds for long-term purposes, and that's why we said negative net working capital means a danger zone. Coming back. Okay, fine. I think more or less the doubts were clear, and I request all of you to please contribute to the feedback. Good. Let me check whether there are any other queries. Yeah, the question of Shiv Narayan is pending. So good to hear from you. Okay. Would need some clarity in understanding the inventory holding ratio. Some customers might have peak sales during Q1 and hence might record more inventory. I'm sorry, where is that? Might have peak sales during Q1 and hence might record more inventory during the last financial year. How to differentiate such profiles from other business where the stock is stagnant? I mean, coming back to Shankar Narayan, if you are having two different kinds of stock, say something like peak and non-peak, it means the business model of the customer has peak period and non-peak period. In those cases, you have to find out what is the inventory holding in the peak period, and that cannot be annualized. Okay, because their annual sales maybe comparatively it would be lower. So if you take only peak period, which is say figuring only in the last quarter, that cannot be annualized. So as a banker, if you are assessing the working capital facility, you have to assess based on peak limit and non-peak limit. That is your sanction, your credit facility or your working capital loan sanction itself should be divided into two. Cash credit for peak period and cash credit for non-peak period, and the cash credit for peak period should be linked with the inventory holding in the peak period, and that inventory holding in the peak period should be separately annualized and seen. Okay, so it is a little advanced concept. I would request you to come back to me, say privately. Okay. So more or less queries have been answered. Miraj Ali, debt service coverage ratio I have explained once again. Now this session has been recorded. It will be shared in YouTube so that I hope you will get a better clarity on that. Just now I have explained it again. Yeah, debtors turnover ratio. Debtors turnover ratio. We'll go back to that example. Yeah, just have a look at this. Let's say there are two companies with annual credit sales of 12 lakhs each. One company is having average debtors of 1 lakh, whereas another company is having debtors of 6 lakh. Now if I create a relationship between these two, that is annual credit sales by average debtors, I get that is 12 lakh divided by 1 lakh 12 times. Here it is 12 lakh divided by 6 lakh, it is 2 times. Now this is nothing but debtors turnover. That is how many times this debtors have been turned over. Here my debtors have been turned over 12 times, here it has been turned over only 2 times. It means I can say out of this annual credit sales of 12 lakhs, what is still pending realization is only 1 lakh. It means I have almost realized 11 lakhs. It means I should be happy about it. Okay, whereas here out of my annual credit sales of 12 lakhs, what is still pending is 6 lakh. It means I am yet to realize another 6 lakh. So higher ratio indicates you are doing good, you are collecting your money faster, whereas lower ratio indicates there is a stagnation, there is a delay. And the same if I measure in terms of period, we call it as debtors collection period or average period, what I'll do is I'll find out what is the monthly sales. It is simple annual sales divided by 12 months. Okay, over here also it is annual sales by 12 months, it is 1 lakh. Now my monthly sales are 1 lakh, my average debtors are 1 lakh and 6 lakh. If my monthly sales is 1 lakh and if my average debtors is 1 lakh, I can say I am having a debtors of 1 lakh which is equivalent to 1 month sales, so I can say my collection period is 1 month. So how I got this? It is simple. I've taken average debtors, I've divided by monthly credit sales. Whereas here, if my monthly sales is 1 lakh, if my debtors is 6 lakh, it means my debtors are equivalent to 6 months of my sales. It means 6 lakh by 1 lakh, I have 6 months as collection period. That's why bankers are going to run away, because they would fear that there will be bad debts. Is that fine? Okay, fine. I think more or less we have covered. So I'll just get in touch with the organizer. Svetlana, how can we go about? Renu Maurya, in capital structure ratio calculation, do we include current debtors? No, capital structure, we are going to create relationship between only debt and equity. So the question of debtors does not come into picture. Miraj Ali, capital turnover ratio. Capital turnover ratio, see in capital turnover ratio, we are basically going to compare the sales and capital. Sales divided by capital employed, that is the focus. If your sales is 100, if your capital employed is 100, it's good for business, because whatever the capital you have contributed 100 has gone out of the business in the form of sales. It is very important that it should go out of the business, because only when you go out of the business you can bring profit. Are you getting me? So if you have capital turnover ratio of 1:1, it means the 1 rupee which you have invested as capital has gone out as sales as 1 rupee, and when that comes back, that would bring profit. But if you are going to invest 1 rupee and if your sales is only 50 paise, then the another 50 paise what you have contributed has not at all gone out. It is still within the company. It means you are not going to earn any return on that. Then how return for equity shareholders can be met out? It's not possible. Okay, so that's the relevance of capital turnover ratio. So I think more or less all the queries have been answered, and it's time for me to leave also. I have an appointment by 2. I should complete my lunch and I should rush up. So I thank high capital turnover. Yeah, high capital turnover means you are doing good. It's a wonderful business, and you will see that in service industries. Your total assets or your total capital will be less. A simple example, chartered accountant firm. The total capital what they will invest hardly 3 lakhs, 5 lakhs. Annual turnover will be like say minimum 30 lakh, 40 lakh. So 40 lakh compared with 4 lakh, your turnover ratio is 10 times, because there is no direct link between the capital employed and the revenue. It's basically service. But in case of manufacturing entities, there is absolutely linkage. Okay, because your assets is only going to help you produce goods, and that will give you sales, and that should give you profit. Fine. So thank you all. Thanks for this wonderful opportunity, especially to Elon Markets for this, and thanks for very patient listening, and that too at a time when you all should be
Muted.
very hungry. Thanks a lot. Thank you.